Good morning. So right now we've got a pretty hot topic running around with the interest rates going. Everybody's been kind of feeling the pressure with rising interest rates. And today we have Tracey Lassere with Assurance Financial to talk about some of, with the increasing mortgage climate, how are, buyers and sellers going to be able to combat increasing rates along with appreciating, price appreciation, because we're still seeing average sales price climb, but the interest rates climbing, and we're having the affordability being able to drop. So Tracey, first off, thanks so much for joining us. And second, how do we combat this?
Yeah, thanks for having me. A current popular solution is a temporary buy down of the interest rate, and that can vary depending on how long the buyers want payment relief. So you can go as long as 3 years or as short as 2 years. And basically, it's a rate option that allows the borrowers to pay a reduced principal and interest payment for a limited period of time. Like I said, usually over a 1 to 3 year period through a temporary buy down of the interest rate. And that buy down is typically paid by the seller or the builder, if applicable.
Gotcha. So, when would you, if we're looking, at contracts, when are you advising buyers to considering these buy downs?
Well, if the first year of home ownership is the most expensive, right? And especially if someone's looking at a higher price point, what they could afford earlier this year, they may not budget for anymore. So let's think about first year of home ownership. Not only do you have down payment and closing costs, but you have moving expenses, furniture, appliances, getting utilities hooked up. You've taken time off of work to do your closing and move and all of that. So keeping that mortgage payment low for the first 1, 2, 3 years can prevent buyers from depleting their cash on hand. That way they have that rainy day fund when they need it.
Gotcha. So how would this be? So it's not really an ARM, an adjustable rate mortgage. This is just lower in principal and interest, right?
Right. Right. So how it works, I'll give you an example of a 2-1 buy down. This is where the rate is lower over a 2-year period. So let's say the prevailing mortgage rate for a 30-year fixed right now is 6.5%. Let's use a purchase price of $250,000 with 10% down. The principal and interest payment for a 30-year mortgage with those parameters at a 6.5% rate would be around $1,422 per month. However, for year one, if you do a 2-1 buy down, the rate would be 4.5%, and the principal and interest would drop to $1,140 a month. That's huge. Wow. Yeah. So when you do the math, even over 12 months, that saves a considerable amount of money. The second year, the rate would move up to 5.5%, and then by the time the third year hits, the rate would be up to the qualifying rate or the permanent rate of 6.5%.
That's interesting because it almost seems like the market's kind of betting on these rates being a temporary thing for right now.
Right. Yeah.
Is this incentivizing for refis in a couple of years when things kind of normalize?
Yeah, it's a good temporary way to get into a house, because we all know things only get more expensive over time. Homes get more expensive. So we've been telling our clients, if you find the house that you really want, buy the house. The rate is temporary. The house is much more permanent. Rate experts are forecasting that rates will start to drop next year. So consider what you buy this year and that rate pretty temporary. But if you did a temporary buy down and let's say rates do drop and or you pay the house off or you sell it within that temporary buy down period, whether you select the 1, 2, or 3 year term, whatever the remaining balance is for the cost of that buy down, you as the homeowner get reimbursed that balance on your payoff. Yeah, so it's not lost money. So as long as the seller or the builder pay for the buy down, then the homeowner is entitled to a refund of the leftover balance of that money.
Gotcha. So it's almost like a discount point, but it drops the payment much more drastically.
Right. Exactly. You get a little more bang for your buck, and it's also available for all loan programs. So conventional FHA, VA, and rural development.
Gotcha. And what's interesting too, this is a way to keep values protected in neighborhoods, especially for folks that have bought in the last couple of years. We're still seeing it's really wild, because one of the things that I keep hearing is the market going to crash? And in order for that to happen, our supply and demand, has to shift drastically from what it was. So we've had a drop in supply. We're still about 40% of the homes on the market today, all over Acadiana. We were at 3,400 homes on the market. Today, we're at 1,486. That's all of Acadiana. That's 0 to $1 million plus. So prices, people are going to start, just for everybody out there, if prices are going to fall, that supply has to get way back over what it was back in the normal market for people to start dropping. So if we're, this is kind of a good way to be able to bridge the gap, kind of a win-win, if you will. You're protecting the value of your house, protecting the value of your neighborhood, and builders, protecting the value of the subdivisions of what's going on, because obviously costs are going through the roof with everything that's happening over the last 2 years. So that's pretty interesting. So
yeah. And this, this could motivate buyers to make offers on homes, that maybe they had their eyes on, that they would have qualified for back in January. And, it just makes it that much more attractive with the climbing interest rates right now.
Yeah. So folks that were in the 3s and 4s, they could afford that back then. Now I'm saying the 3s and 4s, the 4s and 5s, they're back at the ability to be able to qualify for it at that point.
Right. Qualify and afford it. Even if they qualify for it, they may not want to pay that higher principal and interest payment. But, just on the example that I gave, that was almost a $300 a month swing in the monthly payment. So that adds up. $300 times 12 months or times 24, 36 months, that adds up fast.
Absolutely. So is this product, what loans? Is it government, conventional?
It's all of them, conventional, FHA, VA, and rural development.
Awesome. That answers a ton of questions. Thanks so much for jumping in. Tracey, where can they find you?
You can find me at Lassere at assuranceMortgage.com or 337-456-8741.
Thanks so much. Appreciate you jumping in.
Thank you.